So today it's due diligence time. We're going to give you a tool so you can review each of your stock and know what you own and why you own it. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. We are almost done with this investment series on how to invest in 2025. I am with my co-host, Véronique. How are you doing today, Véro?
Mike, I'm doing good because, January 2nd is probably the day of the year where we feel the most tired because, we just went through the holidays, Christmas and the New Year, supper and all that family stuff. And now it's time to think about your portfolio. And we have a special download for you listeners today that can save you a lot of time. So how about that, right?
Yeah, I mean, DSR is all about investing with conviction. And to do so, you need tools and you need knowledge. So this is what this podcast is about, is to give you some actionable tricks that you can use to make sure that you're not getting caught in a bad stock at a bad timing.
So before we start, I invite you to download the stock checklist at thedividendguyblog.com/checklist. Mike, this one page is based on the dividend triangle, the foundation of your investment strategy, and also the one we use at Dividend Stocks Rock. So please explain the dividend triangle to people who might not be familiar with it.
So I like to keep things simple. And after several years of investing, I realized that if I combine three metrics, I can make my life a lot easier because the combination of those three metrics, if they are going up, it means that the company will have a robust balance sheet, will generate cash flow, and will have growth vectors. And it tells you a lot about the company and its potential. So those three metrics are the revenue, the earnings per share, and the dividend. So I look at the trend, so over 5 and 10 years, to see where they're going. So the idea is simple. You want to invest in a company that increase their sales, right? Because if a company increase their sales, it means that they are generating more revenue year over year. So you are looking at a thriving business. So a thriving business is not a thriving one if it cannot increase its profit. So when the revenue grows, well, you also want to have earnings per share growing. So its ability to maintain good pricing power, to maintain their margin, to generate some cash flow will be reflected by a combination of a growing revenue followed by a growing earnings per share. And when you find those thriving businesses, there's one more element to add to it. You want those companies able to have enough cash flow to fuel their growth and also reward shareholders by share buybacks and dividend increases. So the dividend growth will be a consequence of having a strong business with a robust balance sheet and a management team that is confident in the future that they will be able to grow not only the business, but to also grow their dividend year after year. When
Mhm.
you look at the trends, you will also be able to find how the company react to market events. So whenever there you see a fluctuation, such as like a big jump or a big drop in the revenue, for example, then you can pinpoint already which quarter it happened and you can read a little bit more about it. So it helps you understand which kind of story is happening with the company. And if, for example, the revenue keeps on increasing, but the earnings per share is not following, this tells you they have a margin problem. So they are spending probably more in R&D or in marketing to grow their sales, but they fail to generate profit. It's a good strategy for a while, but at one point you want both to increase because if not, you will never find a dividend grower. So a company that is able to increase its dividend every single year.
Mhm. And after a few years of discussing the dividend triangle, you had the idea of turning it into a stock checklist for Dividend Stocks Rock members, which you then shared publicly because it was so useful. So, how can a stock checklist help investors?
Well, the thing is, after talking with a lot of investors, and we're doing a lot of webinars, so we get a lot of questions. And by a lot of
Mhm.
questions, we're talking like hundreds of questions every
Right.
quarters. I realize one thing: as investors, we are very good by making up stories. So the narratives that we tell ourselves about one company or another being so great because of this and that reason is amazing, but we're not so great at verifying those stories with facts. And this
Mhm.
is the checklist is all about. So you can explain me how great company ABC is because it grows by acquisition and it's making so much money and it's growing like in multiple markets. And then you look at the numbers and you see, yes, revenues are growing, but earnings per share are declining, the dividend is struggling and is not increasing. And then it will tell you, well, you're wrong. Like, yes, there is a growth story here, but the company is not able to generate any profit out of it. Well, therefore, the facts backing your investment thesis are pretty weak, and
Mhm.
maybe you should think twice before investing in that type of business.
So the DSR stock checklist is divided into four categories: allocation and role, dividend, safety, and growth. So please define each category for us.
So the allocation and role is to make you think a little bit more about which type of company is in your portfolio. So we have discussed like the categories last episode with core holdings, educated
Mhm.
guesses, and falling knives. In other words, you want to know, okay, so what this company is doing about its business model. Is it a business that will bring growth to my portfolio? Is it a risk that I'm taking? So it's going to bring a lot of volatility, but it could pay handsomely. Or is it a very stable, robust business, boring ones that is just going to be paying its dividend, growing like slowly but surely? And this is the type of stock that you're looking for if you do not want to be bothered by high fluctuations.
Mhm.
Then we have like metrics about dividends. So knowing what is the dividend growth rate for the past 1, 3, 5 years is going to give you an idea if the company is actually in growth mode or if it's struggling. Because if you see the dividend growth slowing down, it's a sign that some other metrics are probably slowing down accordingly. Keep in mind that that management doesn't have to increase dividend each year, but if it does it, well, then it's a sign of confidence. It's a sign that the rest of the business is doing well. Then you have safety. So for the safety, you want to make sure that you're not taking too many risks, right? So you need to understand if there are like potential dividend cut risks. So the payout ratios, the overall trends. You want to especially avoid high risk stocks in 25 because we've been in a very strong bull market for, so 23 and 24 were amazing years. So you want to be sure that you're protected for the year that is coming. Finally, for the growth, well, this is where we're talking about growth vectors. We're talking about revenue growth, earnings growth. So, is this company is currently thriving right now or struggling? So, in other words, if you're using the checklist and after that you realize that you have selected a company that is supposed to be super stable, paying a good yield, but then the dividend has not increased over the past 12 months, that you see payout ratios going up, that the safety seems shaky a little bit, and there's no growth vector, well, then now the checklist is telling you that your story, your narrative, your investment thesis around that stock, not that great. And you should probably review the reason why you have it in your portfolio in the first place.
But Mike, when should we use the checklist? Is it like before buying, before selling, every quarter?
All of the above. uh, more importantly, I think it's a great tool to review your portfolio. What I like to do is I like to combine it with the DSR Pro report. So at Dividend
Mm.
Stocks Rock, every quarter we have a pro report that is being sent to all our members. So the pro report is our team doing the summary of what happens to each quarterly earnings for each company you have in your portfolio. So it's a great way to not waste time doing a checklist of on 30 positions,
Mhm.
because a lot of companies, they were doing great, they're doing great, they're going to do great for the next 6 months, so you probably don't have to spend too much time on those. So the DSR Pro report will highlight your weaker positions. They will tell you where you should put your attention, and this is when the checklist comes in handy. When you have maybe two or three companies that you should do your due diligence, then you back your story with facts, and you are in a better position to take a decision of keeping that company for a while or just getting rid of it, because the checklist tells you that none of the like measure factors are doing great with this stock.
Mike, we discussed that earlier this week, but why is it more important than ever to focus on solid financial metrics?
The investing is kind of ironic. So when the market goes down, people are thinking, I'm going to wait until it goes up. And when market goes up, people are thinking, I'm going to wait until it goes down. So in the end, they're waiting a lot of time. I know it is uncomfortable to invest at an all-time high market, but you have to be used to it. Actually, financial literature tells us that investing in a all-time high market is actually a good time to invest. Of course, we all want to catch the drop, but I mean, if you were not able to catch the drop in 2022 and then in 2020 and in 2018, you had drops like every 2 3 years. And if you were not able to catch those, well, what do you make thinking of like catching the next one? So instead, I'd rather be invested all the time. But being invested all the time is also risky, because whenever the market drops, well, it's like good old Warren Buffett says, when the tide goes down, you discover who's swimming naked. And sometimes it's not a pleasant surprise. So this is why it's important to focus on facts, on metrics, because those don't lie. Numbers will tell you a different story than the story that you make up in your mind. So it's time right now to get rid of those, oh, it's going to be fine, this company has been around for a while, and actually look at the numbers telling you if the dividend is safe, is the stock is thriving, and if there's a future for that company in your portfolio.
Well, thank you, Mike, for building this stock checklist for free. Listeners, download your copy now at thedividendguyblog.com/checklist and visit our show notes at thedividendguyblog.com/208. Tomorrow is already the last episode of this How to Invest in 2025 series. We will end strong with tips on protecting your portfolio from market drawdown at retirement. Subscribe to the show now so as not to miss it. And until then, stay
Stay invested.
invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.